Okay, good evening, everyone. I hope everybody can hear me okay. My name is Mark, and I'm from Right Line Trading. And I don't know how many of you are listening to me talk for the first time, but I'd like to give you a little bit of information about my background and about the philosophy of our company. I'm a graduate of the University of Pennsylvania, and I'm a former professor at Jefferson University in Philadelphia, PA, and I've been involved in the financial markets for well over 20 years. And I began trading the futures and forex markets over a decade ago. And part of my thesis was the optimization of multivariable equations via the use of software systems. And eventually, what I did was I applied that to the movement of the stock market. And essentially what our company does is provide software that has broken down the movement of the stock market, or the movement of the forex and futures market, essentially the movement of price, into multiple independent variables, and then sought to optimize the independent variables to provide you with the best dependent variable, which in our case is a successful trade. Now, I think that the problem with many of the software packages that are out there is that they're really based on the art of day trading, not on the science of day trading. I've listened to many people give webinars, and when I ask them what is the sensitivity and specificity of a trading entry, they do not know. If I ask them what is the positive predictive value of a trading entry, they do not know. And if you do not know those numbers, then you cannot provide a trader with an optimized system, or even make the representation that the entries are going to turn that trader into a profitable one. What we do is we understand the sensitivity, specificity, prevalence, and positive predictive value of all the independent variables associated that we have determined to be relevant independent variables, formulated an equation, and optimized it, and then the result is our software. Now, there are two basic now, when you determine what are the most important independent variables, you have to ask yourself, what is your thesis? What is your underlying dogma? Do you believe that price action is enough to trigger a buy and sell recommendation, i.e., the software just analyzing price action provide you with entries with a high enough positive predictive value to make you a profitable day trader? Or does indicator analysis or a unique composition of indicator signals, some confluence of indicator signals, provide you with enough information to trigger a buy or sell recommendation? Well, it's our thesis and really part of our trading dogma that we don't believe that either one alone provides you with enough information to take a buy or sell recommendation. And this is the problem with becoming a profitable trader. A lot of traders really rely heavily on indicator analysis. And if they fail and if they lose money, they look for the next best indicator, which really is not out there. Just remember that each indicator crunches up 5 parameters. There are only 5 out there. There's volume, and of each formation, whether it be a candle or a high-low close, there's the high, the low, the open, and the close. Those 5 parameters, the 4 price parameters, open, high, low, close, and volume, are the only 5 parameters that there are available in nature or in the movement of price in any financial market for an indicator to use in its formula to crunch out a line. And obviously there are multiple ways that indicators do that, but they're all providing you variations of that same theme. And so they're limited in their ability to provide you with information that has a forward-looking predictive value. Price action is a very strong component of what we use to take our trading recommendations. Now, a lot of the work that I've done on the movement of the stock market is based on a book by Alexander Elder called Trading for a Living. And he was the first person to define the triple screen method of trading. And he did that really in the early 90s when the type of software and the type of data feeds and all the sophisticated ways that we can day trade the futures, forex, and stock markets today were just not available. And he was the first person to say that you really needed 3 screens, you needed 3 time frames, and that there were specific parameters that you needed to use to help optimize the accuracy of your trading entries. And he defined them, although we've revised them because there are now new ways of assessing the 5 parameters that I mentioned to you. Now, the ones that we started with is some oscillator. The second is some MACD-based indicator. The 3 is some volume-based indicator. The 4th is order flow. And the 5th, and maybe and what we believe and rely heavily on and heavily weight in our multivariable equation is market structure. And in addition, we agree with Alexander Elder that fractal analysis, or the assimilation of data from multiple time frames, is probably one of the most important components to go into an indicator. And I'm going to talk more about that in a second. So the goal of right line trading basically is initially to combine oscillator analysis, MACD analysis, order flow analysis, market structure analysis, Fibonacci analysis, and do it. Fractal analysis is essentially, I've seen that word used oftentimes, but the real meaning of fractal analysis is really multi-time frame analysis. All of our indicators assimilate data from multiple time frames, the least important of which is the price and movement from your trading chart. What the indicators do is assimilate data from higher time frames to really provide you with forward-looking data. And what we've done is meld this into a simple trading platform that really does provide you with remarkably accurate trading entries. Now, at Right Line, we do not believe that you can call a top or call a bottom. But what we see all the time are people trying to do that. And these are the traders, and they are never institutional traders. They're always the commercial traders, people like us. They try to call tops, and they get overrun time after time after time. They use MACD divergence. They use oscillator divergence. Whatever indicator they're using, buy and sell zones, they're going to get run over time after time after time. And we do not trade reversals. We never counter trend trade. And the reason we are trend traders is because it's the institutional guys that set up the trend. And we want to be on their side because essentially it is semi-impossible to take money from the institutional guys. What we have to do is take money from the other institutional traders. We have to, with the other commercial traders. A lot of them are smart. A lot of them are not so smart. But we have to do it on a consistent basis and try to make money almost every single day. So we want to be on the institutional side and fight the other commercial traders that's out there. So it's our goal to define a trend early and get on board fast. Now that's a little bit fraught with danger, because the earlier you get on a trend, you can always get on a false breakout type of trend. You'll see how we do it in a way that really allows you to trade with specificity. And that is, every time you get into a trade, it's likely to be successful, but the cost is some trades that do run, some of them significant amounts, simply don't set up for us to get in. But if you're patient and you wait, you're going to get multiple successful trades in the course of a trading day. And I'm going to show you a lot of the trades I took in the live trading room. And I just want to say this: one of the hallmarks of guys who sell you software is they don't trade it, and they don't trade it every morning in a live trading room. And they have these, quote, educational rooms where you go into the room and they give you a retrospective analysis of where you should have gone high, long, or you should have gone short. At Rightline, we don't do that. I mean, we give you when we discuss the market, we discuss what trades we took on the right edge. And that is the most, in all the things I've done in my life, that I think is the most difficult place to be. To be a day trader, a swing trader, whether it be futures, stocks, or Forex, to be on the right edge of the market, your money is at stake, and decide that you want to enter the market, because all those independent variables you have assessed in your head and have determined the probability and the likelihood of achieving success with that entry. Now let's just take a look. This is just an 8-range chart of crude oil. And hopefully you can see my pointer. My pointer is visible, isn't it, Leo? Okay. Now, price action provides you with a lot of significant information. You'll notice that you have a move up here, a move down. That's almost a 100% Fibonacci retracement. And then the move back up is an engulfing candle. And we go up to the top. Then we have the move down and the move up. Now this is really 110%, so we can't take it. But the move down gives you a retracement, and this is a dark cloud cover, and a move down. So price gives you a lot of information. If you can read candlesticks and you look at Fibonacci analysis, it really does provide you with a decent amount of information to trade. The problem is it doesn't provide you with information that has enough predictive value to get you where you want to be. And we've looked at trading price action alone, and it's just not going to help. The problem is when you don't have anything to define a trend is only defined by the candlesticks themselves. It's really just impossible, first of all, to really define the trend, and two, to determine what the longer term trend is by putting up higher time frame charts. It just doesn't work. So what we do is we add first a very simple indicator, which is a 50-day simple moving average. Nothing sophisticated, nothing esoteric. We only go long above the 50, and we only go short below the 50. If we try to go short above the 50, we call that a counter trend trade, and we never counter trend trade. If we try to go long below the 50, that's a counter trend trade, and we don't do those. Now we also add a proprietary 15-day moving average. And if you overlay the 15-day simple and the 15-day exponential over this, you'll see that they crisscross and sometimes diverge really a significant amount. And what we did was we created a line to provide you with maximal stability. And when it's yellow, that's where we believe in a trend trade, we're in chop. Price action does not define a trend, and so we hold off on taking a trend trade. Then we added pivots. Areas went on a move to the upside, the market was turned by a preponderance of sellers, to the downside where the market was turned by a preponderance of buyers. Now we've since really rolled back our pivot analysis and replaced that to a significant degree with our dynamic market profile, which has really just helped us out an amazing amount in making our trades more precise, increasing specificity, and making sure that the entries that we take are going to be successful. Now, another independent variable that is very rarely talked about because very few people understand price action and optimizing multivariable equations, and I'm actually going to go here, is what defines an overbought or oversold condition. And let me go right here. Now, does an oscillator actually define an overbought, oversold condition? Now, a lot of people use an oscillator, and they believe that an oscillator is an important component of their trading. But if you look at the science of day trading, there's very, very little published about whether or not the oscillator as a tool, whether it be stochastic or relative strength or the CCI, actually improves the specificity of your trading. And the oscillator, in our eyes, was probably the most controversial indicator because a lot of people use it differently. There's two classes of people who trade an oscillator. One class of people, when a market becomes overbought, they look for divergence, and what they're looking for is to take a trade to the short side. So they look for oscillator divergence to take a counter trend trade. Another group of traders use the oscillator when it's overbought or oversold to say, well, the bulls are in firm control or the bears are in firm control, and what I'm going to do is I'm going to continue to buy every time a pivot to the upside or a pivot to the downside is broken. So I'm going to use the overbought condition to say, okay, we've got the bulls firmly entrenched, let's continue to go long, or we've got the bears firmly entrenched, let's continue to go short. So what we found was, what we did was, we simply put an oscillator and we put the fast stochastic right at a NinjaTrader onto a platform, and we made a simple program and determined what predictive value the oscillator had in determining the in helping us determine whether a trade would be successful. And what we found was it had zero influence. So it may be the first time that's ever been shown, but we do not believe that an oscillator has any role in trading. And there are software packages out there that really hinge their trading on this indicator. But I can tell you from doing a year of market replay analysis and doing it over and over and over again that the oscillator doesn't help one bit. And that's the problem with trading based on information you received from someone who received information from somebody else. Where's the scientific data to back up that an oscillator actually improves the predictive value of your trading? Where is the actual scientific work? We don't want to make day trading an art. We want to make day trading a science. And if we use an indicator, we want it to be shown in a systematic fashion that it helps us become successful, and the oscillator does not. So what we found was that the difference between the 50 and the 15 is what determines whether a market is overbought or oversold. Now, let me see. It's the space between the 15 and the 50. As this space widens, you get to a point where the market's oversold. So what we did was, we did multiple years of market replay data, and what we did was we came up with an indicator that shows the MA diff. The MA diff is simply the moving average difference in ticks between the 15 and the 50. And on an 8 range, when that MA diff is greater than 18 ticks, you start to accumulate risk because the market becomes a little overbought, then a little more overbought, a little oversold, a little more oversold. There's no absolute cutoff for a trade, but you understand that with an MA diff at 18 or less, the market is not overbought or oversold, and the predictive value of those trades are going to be the highest. There are certain trades when you become a little more sophisticated, a trader, that allow you to take a trade with a bigger MA diff. But on a trend trade, we want the MA diff on an 8-range chart to be 18 or less. That's the parameter that determines an overbought, oversold market, and that's the parameter that's going to directly affect the positive predictive value of your trading entry, not the oscillator. So what we do now is we totally ignore the oscillator. We don't care what it says. Now, the other independent variable we found, a very important independent variable, is the distance between the open of the candle body and support or resistance. If you're taking a trade, say off the 15, you want support. You want to be tight to support on a long, tight to resistance on a short. And we did multiple years of market replay data to determine what is the maximum difference you can take a trade off support or resistance. And it turns out to be 4 ticks on an 8 range, 3 ticks on a 5 range, and 2 ticks on a 3 range. So we created another indicator. And that indicator always tells you, just by looking here, the distance between the modified 15 or the 50 and the open of the candle. The problem is if you take this too far off, you have no guarantee that the price is not going to retrace further back to support. If you take the trade right off support, you're really not going to get price coming back to support to stop you out on a trade that then continues to the upside. So we created what's called the 3-line indicator, which we don't even project anymore. Now, line 1 is order flow, which is a very, very important parameter. It looks at the number of executed buys and executed sells in one tick and compares it with the previous tick. There are more buys in the tick that we're in versus the previous tick. The market is going to move up. Number 2 is the stochastic line, which we don't even look at anymore. And number 3 is momentum, which is MACD analysis. And that is an important parameter, which we did prove via multiple years of market replay data, and that does have an effect on the positive predictive value of a trade. Now, what's important is that order flow and momentum on your trading chart are not what are going to help you trade. It's order flow and momentum on the 2 higher time frames that are going to help guide your trade. And you're going to see that when we move to the platform. So when order flow is down on 2 higher time frames, your first line is red. When momentum is down on your 2 higher time frames, your third line is red. We don't care about stochastic. You need to see how we simplified this line very much on the trading platform. So basically, we're looking for alignment of order flow and momentum on the 2 higher time frames. We really don't give much of a hoot about what's going on with order flow and momentum on your trading chart because they don't give you any future predictive value. It's the higher time frames that rule. So we look for a red on the first and third line or a green on the first and third line. Now, what was an easy way for us to project this data without actually showing the 3-line? Because the 3-line is cumbersome and it's tough to read. So what we did was, what forms intra-candle is a line or a halo around the bar. And you can make this as thick as you can, and you can also make it any color you like. I mean, I like to make them blue. So when order flow and momentum are aligned to the upside on my two higher time frames, and I break the 50 to the upside with the 50 up and the 15 up, that gives me a trade to the long side, one tick above the close of the candle. Every parameter that we know is extremely important in taking a successful trade has been optimized on this entry. The same thing to the downside, outlined in yellow. Again, and these are colors that you can play with. You make them any color you like. Order flow and momentum are aligned to the downside on multiple higher time frames, your two higher time frames. And you break the 50 to the downside with the 15 and the 50 down, and you have a nice short shade. Whoops. Now you can break the modified 15. As long as you break a trend line with order flow and momentum on your higher time frames with you, and the 50 and the 15 down on a short, 50 and the 15 up on a long, remember we only trend trade, you got an entry. Here you have a re-entry. Now what we did is, and you can simplify this easily, is that when you have order flow, stochastic, and momentum, I made it yellow. And when you just have order flow and momentum, I made it pink. But I know that the predictive value of both those outline colors are exactly the same. So you can just make them one color, yellow or pink or whatever color you like to the downside. It does not make any difference what that middle line does. And here's the same trade again to the upside with order flow and momentum. Now, this is a market structure trade. We have a lot of respect for market structure, and I really want to move to the platform pretty soon. Now, to take a short, optimally, we need the 50 down and the 15 down. And we need the open of the candle to be tight to resistance in this case, since we're going short. Now, the A here is printed by the software anytime two candles of the same color appear, because that defines a trend. Two green candles, you get an A. Two red candles, you get an A. Then we look for those unfortunate traders that are trying to counter trend trade. Now, this is clearly a developing downtrend. The 50 hasn't quite rolled yet, but you're below the 50. The 15's heading down hard. The 15 has crossed the 50 to the downside. All these long traders push this candle to the upside. When it closes, the software prints a B, and you get an audible alert if you want. I like to color my Bs magenta, but you can color the B any color you like. You don't have to color it at all. But just to highlight to me that what I have coming up is a potential engulfing C. I want the audible alert, and I want my B candle or the counter trend candle to be highlighted for me. Now the C starts to flash, and we know that we have the potential for an engulfing candle, and we have a range maker, which is not an original indicator. You can get it any place on the internet for free, and what it does is on a range chart, it shows you what it estimates to be the close of the candle. Your short entry is going to be one tick below the close of the candle, and you can place a short right there, right at the start of the C formation. Now the C may not close exactly where it's first estimated to be, and you may have to adjust, but just in case the C blows through, you've got your entry in. Now as long as there's the potential for an engulfment, you're going to get that C flashing. When the candle engulfs, the C prints, you already have your, in this case, your sell stop or your sell stop limit, depending on what you like, in one tick below the close of the candle, and down you go. And the impetus for taking a short trade here is dual. Not only do a huge number of sellers pile into this candle, but you're stopping out all the people in this counter trend candle. All of these long traders, once you click one tick below the close of the C, they start to get stopped out. And that's so you have two forces pushing this trade down. And that's the kind of trade we really like. We get lots of B candles. Not all of them are tradable Bs, and sometimes and we get C engulfers. And they have to be in the right spot. But traders are always trying to counter trend. They're always trying to trade tops and trade bottoms. And for us, they create trading opportunities. Now, if the A, B, and C are successful and the C is overrun, you get an engulfing C that loses. If the C doesn't engulf, the entire ABC pattern disappears because it's not a real ABC pattern. And this is based on Elliott wave. You have wave 1, wave 2, and the C is wave 3, and wave 3 is the biggest wave in the Elliott wave pattern. That's part of market structure, and that's the only component of Elliott wave that we use. And here's a C candle coming right off of a trading chart. We have the move down, we have the retracement, the engulfing C. Now, adding icing on the cake is the fact it's surrounded in pink, so order flow and momentum are with you on the trade on multiple higher time frames. You're in one tick below the close of the candle, and down you go. Here's another C. The move down, the retracement, the C candle engulfs the long trade, all the people who've taken long positions in B, engulfs them and fires down. These are the traders, and these are not institutional traders. These are the commercial traders we're looking to exploit. And I think, we have momentum entries, which we really don't use very much anymore, and power entries, which we don't use. So what I'm going to do right now is I'm going to go over to the platform. So hold on one second, and I'm just going to move from shooting the screen from slides over to our actual trading platform. Now I want to bring it over. Okay, now here's crude. Now this is the actual trading day from today in the market, from the live trading room. This isn't, this is not, let me just take off some of these lines. I've got some things here that are important. I just don't want to make this too complicated. Now, the background bias, which I haven't discussed, and I don't want to throw too much information at you because you're going to think that the software is confusing to trade, and it really is simple. Looks at market structure and price action on our two higher time frames. On an 8 range, that's the 13 range and the 21 range. If you trade a time chart, say a 2-minute, it's going to be a 6-minute and an 18-minute. If you trade a tick chart, say a 377, it's going to be the two higher fib tick numbers. I think after 377, I think it's 610, and then after that, I can't remember what it is after 610. But it's always going to trade. It's always going to analyze the price and direction on your two higher time frames. So what we like to look at are indicators that are unaffected by price action on the trading chart. These are what provide you with forward-looking data that help you get better trades. So I'm going to go back a few days, but I'm going to show you the first trade that I took. And in order to do that, this is our market profile. Here's our value area high, here's our value area low, and here's our point of control. Background bias tells you the alignment of price action and market structure on two higher time frames. Remember, the halo around the candle tells you if order flow and momentum are aligned on higher time frames. So the platform, obviates the need for you to sit there with multiple charts. Like, you don't have to have the 13 range and the 21 range open, or if you're trading a 2-minute, say, or a 5-minute, you don't need to have your 15-minute and your 45-minute open. The background bias and all the indicators are going to give you all the data that you need. On this particular trade, we had a move up, which we couldn't take because it didn't meet our definition of a break of the 50, but we got the retracement back to dual support. The support was our modified 15, as we call it, and the value area high. And we know that the 15 is up, the 50 is up, and background bias tells us that market structure and price action are moving along on our 2 higher time frames. We're in 1 tick above the close of the candle, and I'm right on the right edge, just where I was when I took the trade, and the trade went up 20 ticks. Now, right here, I took a trade we haven't talked about. It's a break of the 15 with order flow and momentum. You can see the candles outlined in blue. I went long. Our first target's 5. It just went 5. And we had nothing to trade. Then I waited for the market to break the 50. You can't take a short on a rising 50. You got to wait till the 50 rolls. And you can see here, the 50 is yellow, and we can't take a short on a yellow 50. So I waited for the market to retrace right back to resistance. This is an engulfing candle. I was in 1 tick below, and it went right down to the point of control and bounced, and I got 13 ticks off of it. And I didn't want to take a trade into the point of control. It broke it and then retraced right back into it. And now I had dual resistance, the point of control and the modified 15. And I went short, and the trade went 39 ticks. That was our last trade of the day. And we closed. And I'll show you how we did for the day. But I'm just going to, and that was really about it for the day on crude. Now there's multiple other, this is a very, very powerful way to trade is a move out of consolidation. And we have a consolidation indicator. It's this triangle. And unless the market's overbought or oversold, you almost always break out of consolidation in the direction of the trend. And since our system defines the trend, this is yesterday in the trading room, I took a move up, a move back, the 50 was up, the 15 was up, I got that bounce, and the market and the trade went right to the value area high, didn't break it, we got 12 ticks. And you can see when background bias is pink, when price action and market structure are heading down on your 2 higher time frames, you can see, and what I say in the trading room is we are looking for a conservative short entry. We are not going to go long throughout this period of pink. We want to, again, we are devout trend traders. Now, I want to show you a few other markets, but I just want to talk about our quant lines. And this is this line here. And I think we're the only people who have ever made this indicator before. And it's very, very helpful to trade. And it's really the quantitative analysis of multiple correlative markets. Now, I think everybody in the room knows that when crude falls, certain other markets fall as well, and certain other markets go up. In order to determine which markets these are, you have to use a year of market replay data. So what we did was we found 3 markets that either move up or down with crude with a correlation coefficient of 0.7 or greater. So 70% of the time when crude falls, these markets fall. Or when crude goes up, or when crude goes up, down, these markets go up. And what this really is the acknowledgement of this, and this is really an important fact, and that is that you have to look at the market as having a fixed amount of money in it all the time. And all the institutional guys do is they rotate it around. I mean, if they feel very risk averse, they move it into bonds and notes. If they feel that they want to take more of a risk, they move it into stocks. At certain points, they're going to move it into commodities. Other time, they're going to move it into agricultural commodities as opposed to energies. Or they can move it into currencies like the 6E, the dollar, because we're not going to talk about the FX or the euro dollar cross. We're just going to talk about futures. So they move their money around, and what this line is telling you is that based on our correlative markets, money is flowing out of the crude oil market. So the red line, in conjunction with the red background, which is looking at price action and market structure on 2 higher time frames, just tells you that bias is so strongly to the downside here. You're simply looking for an opportune place to go short based on market structure and price action, which is really key. You've got to find a good place to go short. And right here is a great place to go short. You have the move down. Now, it's the middle of the night, but you move down, you have the move up. The retracement is 70% or greater. Now, we'll soon have an indicator that will indicate when it's 70% or more. This is an engulfing candle right here, the A candle, and you're in. Depending upon how you set your ATM strategy, there's your perfect short based on Fibonacci movement and the fact that this candle engulfs and the fact that the 50 is red and heading to the downside. That's the key. And you have a red quant. Money is flowing out of the market. And when you combine all of these analyses, you just very, very rarely get a loser. And what I'm going to do is, let me move over the E-mini. This is the E-mini. On the E-mini, we have 3 quant lines. We look at 9 correlative markets. And when they're all green, money is pouring into the E-mini. When they're all red, money is pouring out. If you want to wait for a perfect trade and for the 3 quant lines to be red, like right here, whoops, wrong button, the predictive value of this short is exceedingly high. The predictive value of this short, exceedingly high, because all 3 quant lines are red. Now here's a trade that I took. I took this today. And if you look on the right edge, you'll see that what I did was the market came up, and you see we can't take a long through a falling 50. So I just waited for the market to move up and come to the area of support, which was the point of control of market profile. I looked down. I had 2 of my 3 quant lines green. I had 1 yellow, which is okay. The candle was outlined in order flow and momentum to the upside on multiple time frames. My background bias is green. Order flow and price action are long on multiple higher time frames, and we went up. And we went up for 2.5 points. And if you just have patience here, because you have to wait for all these things to align. You're going to wind up with multiple winning trades. Now let me show you, let me bring something else over here. We're very shortly going to be trading stocks. This is the same E-mini. I don't know why I'm using this one, but I wanted you to see how stocks move. Now we're looking for, in order to make the stock trading available to everyone, we can't trade Google. It would be great to trade Google, but we can't do it. Nobody can afford to do it. So what we're looking at are small caps with a lot of volatility. I mean, and one of the stocks I like is Sun Edison, and I've been looking at this stock a lot. And we have to trade it on a 3 range. And I'll show you Facebook. And what you get, this is the middle of the night. We have to wait for it to set up. So here's a long trade right here. A break of the 50, 15's up, 50's yellow. You can go up right here. This is a more complicated trade. It's a break and retest on a falling 15. Remember, we rely heavily on market structure. This is a terrific trade here. There is our consolidation indicator. We have the move down. It tests the point of control. Whoops. Comes down, retests the point of control. We're trading out of consolidation. And down we go. Now let me show you Facebook. Now the quant lines don't work anymore. We don't have any quant lines for individual stocks. Let me show you Facebook. But the same signals we take on the futures market were great on stocks. Now here's Facebook. Now this is a 3 range, which is too choppy. Here's a 5 range. And forget about the quant lines because they're not working. Now here's Facebook. Now there's an extra indicator on here. I don't know how it got on here. This pivots shouldn't be here. I think somebody asked me to put it on, so I did. So here is our right edge, which is really what we're looking for. Let's take a look at the market open. I hope I haven't put everyone to sleep. But this is really the information you want to see. You don't want to hear somebody pontificate about a system that they just don't show you or they don't trade because it's never going to work for you. Now, I don't know how fast the market is moving right here. You can see the time. And I think right at the market open, even though you have a nice short trade here, I don't think in real time you're going to be able to get it. So I'm not going to show it. And forget the quant lines. You see you're trading right into the value area low here. So you really can't take a trade. There's the point of control. And there's the trade. Move up. Well, it's really not a trade. I'm sorry. Well, here it is, right here. The move up, the move back. You see that it's trading out of consolidation right here. It's going to give you a first target. Then it's going to come back. I'm trying to give you entries that I would take myself. I was trading this. It really moves a lot. Let's see where we are here. Here's the trade, the move up, the move back. And you can see 2/3 of this candle is above the 15. And the background bias, which does work, is telling you to go long. And you have a really, really nice long on Facebook. Just got to wait for it to set up. And there's your short right here. The move down, the retracement, right back to dual resistance, and the short right here. And down you go. I'll just show you one more stock. Let's see. I'll show you the NASDAQ. And I just got to move to an 8 range. Now this is not the NQ quant line indicator. This is the E-mini quant line indicator. So let me switch them. So this is the quant lines for the ES. And we got to go to the quant lines for the E-mini. Now I think I'm missing some indicators here, but here's our NQ. And we got to put that in panel 2. And I don't even have the contracts per minute here. That's just good enough. Now this is the actual trading platform with the appropriate quant line would use to trade the NASDAQ. That's pretty choppy. Now here's your long trade right here. 2 out of 3 quant lines, background bias, a move out of consolidation, and there's a move up. Now we have an indicator that does allow you to take this trade. I just don't have it in the platform for some reason. Let's see if we get anything else here. Here it is, the move down, the retracement right here, and the continuation short. Oops. On 2 reds. Okay, so I hope this, you know, the purpose of the webinar is not to teach you how to trade the platform. It takes a little bit of time. But here's the important thing that if there's a takeaway message, this is it. If you're doing indicator analysis to try to make you profitable, it is not going to work for you. That is not the way you can trade. If you're looking at indicators that assimilate data from your trading chart, they do not work. If you don't have a tremendous amount of respect for price action and market structure, not only that's important on your trading chart, but so is price action and market structure on your 2 higher time frames. So if you don't have the background bias we have on our platform, you need to look at those 2 higher time frames and make sure that they're aligned in the appropriate direction. I mean, you wouldn't take a long trade on your trading chart if your 2 higher time frames were heading down. So the trades with the highest positive predictive value occur where all of your time frames are aligned. You've broken on a long trade all resistance to the upside. Your 15 and 50 are moving to the upside, and price action is moving to the upside. That's what that background does for you. And price action rules, indicators confirm your trade, and they give you what I believe to be the highest predictive value for taking a trade. That means that day trading is not easy. It takes time. You have to learn how to read price action, but in the trading room, that is what we teach you. It's an educational experience. There's also a mentorship where I work one-on-one with you for 2 months and teach you everything. And I really do turn out professional day traders. But there's also the day trading room. And really, the bottom line is that these, go long blue dot, go short red dot systems will never make you money because 10% of trading is discretionary. And as long as I don't want to sound like a broken record, but as long as you understand all of the independent variables that go into taking a trade, you can make an appropriate risk assessment of the trade. And if you're risk averse, if you only want to take the most conservative trades, you will know when they come. It's when background bias is pink on a short, green on a long. When the 50 and the 15 are both heading up, or both red heading down. When you're tight to resist to support on a long, tight to resistance on a short. When you have a C candle entry, a dark cloud cover, or a piercing candle on a long, these all define risk. And when you have these, we have traders in the room that just sit and wait. We have guys in the room who trade a 50 lot. They don't trade marginal trades, which occasionally I take. They wait for the high probability trades, which I believe are close to 90% winners, 9 out of 10, and maybe even higher if you take them with decent volume. So the important thing is that we provide you with extensive videos, group and personal mentorship programs. We really do support our software. The other thing is I consider a boot camp, when people offer you boot camps to come in and ask you and charge you more money, that's an admission that their software is broken and they want you to pay more money to learn how to trade it, quote, correctly. We don't ever ask you to do that. We have proprietary seminars and lectures, which we only hold for members of Rightline, and we do those for nothing. When we upgrade the system, all our new indicator packages are always free. Like we're adding on a stock day trading room shortly. If you're a member of Rightline, you get to come in for nothing. We don't trade you when we offer additional, we don't charge you when we offer additional services because I don't feel that it's appropriate and it's just not, I don't think it's ethical. If we add on a new package and you're a member of our service, you get it. We add a new service, you get it. And they're all yours as part of becoming a member of the Rightline Trading family. Now, I think that's it. So here's what I would like to do. Leo is going to put a link to our room in, and I would like you guys to come, and ladies, to come into the room for a free trial. I don't even want you to buy anything. I'm not going to make you any cheap offers or do any sales pitches on you until you see how well the system works and how well we day trade it. I mean, we rarely have a losing day. And I have to tone down a lot how I proffer money. But I will show you this. I have to go here if I can do it. I can't. I just want to go to Microsoft Word if I can find it. Yeah, I can't do it. If you want to see my son, that's a little picture of him. But if you go to www.rightlinetrading.com and you just scroll down, we're in the process of having the whole website rebuilt. You will see a spreadsheet that you have to click on, day trading results. Each day we post a net equity based on our ATM management of our trades. We don't just post 39 tick winner. We tell you how much we made on it. And each day we post a net equity. And I don't know that there are very many other software companies like us who do that. And I'm in the room every morning duking it out with the market. And the thing is, I talk out loud and give you the rationale I take for every trade or why I pass up every trade. So let me just go to the questions really quickly. Okay. I can't see. Okay, hold on one sec. Hey, um, no, John, we never taught divergence. And the reason we never taught divergence is we don't start teaching anything until we've proven that it has predictive value. That was the problem with the oscillator. We first added it into the line, but like I said, our mantra is we don't counter trend trade. That was always part of our trading dogma. So, and divergence is a counter trend signal. So we never traded divergence ever. But we've only in the last year and a half eliminated the oscillator completely because it really does not scientifically add to the positive predictive value of a trade. I like the futures trading versus uh, I've traded the Forex. I just don't like the spread. The signals on the Forex are great. If you want to trade the Forex on a 5 range, you get tremendously good signals, D. But and part of that actually is the fact that I don't like to trade in the middle of the night. And if I'm going to trade, I'm going to trade the European session. That's one of the reasons why I don't trade the DAX, which I think is an awesome market, and we have a lot of people trading the DAX. They trade it on an 8 range. It trades a lot like crude oil. And also the problem with trading the DAX in the room is the margin is huge. Uh, it's just a personal preference because you will get really nice signals on the Forex. You'll get a copy of the recording. The platform that we're active on right now is on Ninja, but we will soon be on Sierra very shortly, probably in a week, and then maybe a week after that we'll be on multi-charts. You can trade the pre-market session, and we watch the pre-market session. The only thing that bothers me about the pre-market session, and this is only my preference, is that there's such light volume. I mean, if you get a great signal on the pre-market, you can certainly trade it. We watch the ES, we watch the Russell pre-market. Uh, just be careful when you trade light volume because people can step in and move the market on you and it can be manipulated. But you can certainly trade pre-market. Absolutely. Well, the NDT was not part of what I wanted to do here. I'm going to go back to that NDT because I'll show it to you in 5 minutes. It definitely works for swing traders. We have people who trade 4-hour bars, 8-hour bars, daily bars. It doesn't make any difference. If you set a daily bar or a 4-hour bar for swing trading, the system will automatically recalibrate all the higher time frames. Your next bar is going to be a 12-hour bar or 3 times the 4 hours. The next one is going to be a 36-hour bar or 3 times your 12-hour bar. So you can trade